Hello traders, Gary Wagner here. It is 12 noon in Honolulu, 6 o'clock in New York on Wednesday, 10th day of July 2024, and this is the evening report for gold and silver. Gold prices had modest gains today of $11.80 or 0.5% in New York trading, taking a troy ounce to $2,379.70. It is currently just opened overseas, down $2 from New York's close at $23.7770. A very muted day for silver in New York trading. Silver gave up 4 cents, but now in Australia, it is up 6.5 cents, with the most active contract fixed at $31.08. It seems as the dollar has returned to its primary trend direction, which is to have lower value, after trading lower for 7 consecutive days. Both Monday and Tuesday resulted in small gains. However, today, the dollar did return, delivering lower values, down 0.11%, taking the index to 104.994. Gold recently broke above its 50-day simple moving average on the first day of March and maintained a price above that up until the jobs report on Friday, June the 7th, took gold $80 lower and also moved current pricing below its simple 50-day moving average. That is the gauge that we use to determine whether on a short-term basis market sentiment is bullish or bearish. Of course, above the 50-day moving average is bullish and construed as short-term sentiment turning bearish when it trades below that. On Wednesday of last week, on the 3rd day of July, gold broke back above the 50-day moving average and has remained above that in terms of open and closing prices for the last 4 consecutive days. Although, as we mentioned yesterday, we did get lows that occurred below that. Gold did open and close above that critical value that traders watch to determine short-term market trend. That being said, we've also seen strong resistance come in right at around $2,400 per ounce. We can make note of this top that occurred on Friday, May the 10th, and then to the double top. The first instance was the day of the jobs report, in which the high came in at around $2,400 and the open was just below that at $23.95. And then again, beginning on Friday of last week, when gold traded to an intraday high just below $2,400. After the weekend, gold opened just below $2,400 and broke strongly to close at around $2,364. A very small-bodied, almost doji candle occurred yesterday with a price gap above yesterday's close today and a modest gain of about $11. The key right now is that although we are bullish on the market, we have to acknowledge that we are cautiously bullish, and that is because gold has been unable to effectively close above $2,400 per ounce and is currently sitting within striking distance of that, roughly $22 away from that elusive benchmark that gold has been unable to breach. Which is why we have to analyze the risk-reward to our next potential trade. Although we are bullish, we acknowledge strong resistance at $2,400, which means that the potential before hitting resistance is only about $20. A solid break above $2,400 on a closing basis would indicate that we could make a run for at least the first of the 2 record highs that were achieved in April and then in May. But the risk-reward doesn't make logical sense unless we can find a more favorable entry price. And it is for that reason we might not issue a buy trigger prior to the release of the CPI inflation report tomorrow. And traders, we can really see the lack of any kind of strength in the current uptrend. We have converted our Japanese candlestick chart to a Henkin-Ashi. Of course, the Henkin-Ashi fixes the open on the midpoint of the prior candle. In the case of a daily candlestick chart, the prior daily session, you can see that when we do have strength, it's defined by very large body size and the absence of lower wicks. As we got to a top back in the middle of April, you can see that we had the emergence of lower wicks as well as a diminishing size in the size of the green candle until it went from green to red, in indication of a pivot or key reversal from bullish to bearish. We can also see that on this bottom, where you had strength at the beginning as recognized by no upper wicks, but then wicks quickly emerged as the market began to become oversold, and that key reversal. And right now we're sitting in an area where we do have slightly alternating candle color, but more noteworthy is the lack of any real body size like we saw back last week on the 3rd as well as the 5th. Large body size and the absence of lower wicks. We're not seeing that now, and that is why we are exceedingly cautious about entering a trade prior to the CPI report, and yet believe that there is a high probability that gold will move higher if in fact the current estimates prove to be correct. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.